I tend to not love nor hate companies. What I want to keep reminding ourselves on is, Airbnb has been, whether you like them or not, and I wouldn't say that I necessarily like them. I see them as a necessary evil that's done, sort of a lot for the industry. But Airbnb has been the big success story in our industry, and we tend to forget that when we engage in Airbnb bashing.
We're not here to bash Airbnb. I'm fascinated by this company, but we're also not here to call them a cash volcano or some of the other things I've heard.
Straight Fire VR is streaming now. It's market check time, and today we're looking at the companies in play as well as their strategies that are driving their wins and losses by the numbers. Our returning guest is the CEO and founder at Properly Inc., as well as proven prediction speculator on our show, Alex Nigg. Making the call on the winners and losers in the market is our host of Straight Fire VR, as well as the founder and CEO at V-Trips, Steve Milo. Steve, go ahead and let us know what the
All
forecast
right.
holds.
Hey, thank you, Heather. I'm pleased that we have a returning guest, Alex Nigg. He's been really at the forefront of taking a look at some of the public companies in the sector, in part because he's CEO of Properly, and he received a lot of funding through private equity, and in part of his past background was dealing in private equity in San Francisco. And the reason why I wanted to have Alex on right after the summer is, to start with, we just got the Vacasa public earnings for quarter 2. And Alex, I'm going to just throw it right over to you because I'm a little confused by some of the stuff that came out during the earnings call and the shareholder letter, but maybe you can help unravel what's going on at Vacasa.
Yeah, I mean, first of all, thanks very much for having me. I always enjoy being on your show, Steve and Heather. Um, Vacasa, I think, is a difficult one. The big picture is obviously with EBITDA not being where they thought it would be, they needed additional funding, and that additional funding came at a very steep price. It's from a company that's known to be a distressed lender. Um, so I think what we've seen in the announcement is both it sort of like removes the immediate liquidity threat from Vacasa, but at the same time, obviously, it comes with very onerous terms attached to it, which decreases the value of the equity for the existing shareholders and hence the share price fall. I think the bigger picture for Vacasa is probably that they're still in search of a business model. The original business model was a heavily centralized system, whereby they can make investments into central assets such as brand equity, and then benefit from that to also get economies of scale. I mean, clearly that's not worked out, as Vacasa has a higher cost position than many other managers, and certainly not a lower cost position. What they ended up doing is they layered the local cost on top of the central cost. And the current management team is trying to undo that, focusing back on local operations. That's an expensive problem to fix, and I think it'll impact earnings for a while. But the bigger picture then is, does this mean that the centralized model doesn't work at all? I mean, obviously, clearly Vacasa is retreating from it.
Well, let's get back to that in a moment. And I'm going to just kind of throw down some data because we kind of talked around some of this. So their earnings for quarter 2 were disappointing in a sense. If you compare to 2023, revenue was down 56 million, which was about 22% from a year ago, which is a huge number. Now, they cut their G&A by quite a bit, but it wasn't able to make up for the loss of revenue. And if you I have a little balance sheet and I take a look at add backs and depreciation and things like that, I still have them losing $59 million over the last 12 months. So they're not a profitable company. They were not even profitable in the second quarter. And from what we understand throughout the US, July is not a great month. That's certainly some of what's been reported by companies like AirDNA and Key Data. But I want to get to a couple things that you kind of alluded to as well. So after the earnings report, one of the things they said is they had agreed to terms on a $30 million what I'd call subordinate debt fund from a company called Davidson Kemper. So this is what would be called a high interest fund, and then it could go all the way up to, I believe, 75 million, right? So this is what you alluded to as giving them some cash. These things are typically at extremely high interest rates, and it would be subordinate to the existing debt, of which they already have $88 million that they pulled down from the revolver. So clearly the stock market did not like this, because their share collapsed in one trading day by 37%, and it hasn't recovered. They're down trading to about $2.40 a share, and that would put them at about $54 million. Remember, they went out at 4.5 billion. So there's almost been a 99% decrease in the share. So let's just go back to this subordinate debt, right? So you said, the subordinate debt will help with their cash flow. Clearly, the shareholders didn't think so, because it looks to me like they think if this debt provider takes over the company, the shareholders will be left with nothing. But if you see this differently, let me know.
No, I mean, I don't see it differently. I mean, it's very clear that Vacasa's management team was striving for profitability this year, and as you said, clearly it didn't pan out. Now, having a company that's forced to raise money in this market, in the situation that they are, is obviously not the outcome that they were looking for, and they paid the price for it. And I think that's what you see in the share price. I think the bigger question is, how did they end up in this situation? And because that, I think, is interesting for us as an industry. I don't want to sort of do Vacasa bashing by itself, but focus on what the bigger lessons for the industry are. And as I said before, their management team has a tough problem to solve, and sort of I wouldn't want to be in their shoes. I think the big question for us as an industry is, we've all been riding high on things that weren't our fault, as in like that we really didn't have much to do with. Post-pandemic, there was a huge boost in demand for the entire industry. So we all delivered better results to owners, and we could coast on that for a while, and sort of all was good.
Okay. But Alex, I'm going to get back to the industry issue, because there was a pretty interesting, entertaining thread on LinkedIn that Amy Hinote posted. And I do think one of the things that was brought up by a European consultant was this issue of why hasn't this business model worked in the US, but it works in Europe. But I need to go back to this issue of Vacasa, because this is partly why I brought you on. So my understanding is you have a board of directors, and you have Silver Lake and a couple other private equity companies that have put in by what I believe is over $800 million of legitimate capital. I mean, legitimate capital went into this company, which is why I lost a bet to you that I thought Vacasa was worth over $1 billion if it was sold in parts, because the value of the contracts, right? And there are still 40,000 homes under contract according to their last quarter. But clearly the market is seeing this differently. But what I don't understand is, with all this money that's been invested, why would the board of directors allow the company to take in subordinated debt at 30 million that gives them 2 board seats and a lot of other governance? Why would they do this and effectively take away any ability of common shareholders to really control this? Do you have an answer for that? I mean, I have one idea that I suspect.
I think the answer is a very obvious one, that it's better than the alternative, and the alternative is bankruptcy.
Okay, well, that could be one. Do you think it's also, could it be a bridge? Could they be literally in the midst of selling the company? Could one of the ideas have been that one of the companies that just recently took an interest in Sonder, may have been at the table also talking to them. I mean, this sounds like a bridge. I mean, why on earth would you do this versus trying to sell the company 12 months ago?
Well, I mean, clearly, like this is not a good market to sell Vacasa. And I mean, you see how the market values Vacasa at sort of somewhere between 25 and 50 million. So if I've got a 850 million or $800 million sunk into the company, that's not a great outcome. And yes, it's unclear that anybody was interested. If they were trying to sell the company, which we don't know. So yes, clearly, I mean, they tried to raise money, or they did raise money. So because they believed that the company, clearly, I mean, the board must believe that the company is worth more in the future than it is today. And if they can extend its runway into the future, then sort of let's have another day and see what happens. That's why I think sort of the more salient question about Vacasa is there a business model that can work for them? I think you've said for a long time, rightly, that property management model is a very old one, and most property managers most of the time make money. So there shouldn't be a good reason not to make money unless you're trying to tweak with the business model and do something differently, and that something doesn't work.
Okay, well, let's talk about the business model. And then again, I still think this doesn't make any sense unless it's a bridge and they're going to sell parts of the company in pieces. And you've heard the rumors, I've heard the rumors that various people, companies, entities are looking at the pieces, right? So I know a group in the Panhandle, which would be, the Panhandle of Florida, all the way to Alabama, that's looking just to buy that piece of business, which was a lucrative business at one point for Wyndham VR. And I think Vacasa probably has 5,000 or 6,000 properties in that corridor. Another person I talked to was looking to buy Orlando. Others have been looking to buy, items in the Northwest, whatever. The theory is no one company came to the table and was willing to offer a premium for the whole piece, but there is more likely to be a premium for the parts. But let's talk about.
I think, Steve, so I think we're saying the exact same thing, because I think that goes back to the business model. I think the current management team has very clearly said there is no central business model. They're actually heavily retreating from that. They're cutting central functions and moving everything back into the regions, which has been the traditional model that property management is a local business. And that would then fit perfectly with what you just said, because if there's no central economies of scale, then there is no value in the central piece. Then you may as well sell it off for the pieces, because the pieces might be more valuable and might find ready buyers because they'll have synergies with whatever local portfolio they have.
All right, let's talk about the business model. So let's start with the good news. Over the last 12 months, they still have $1 billion of revenue. 1 billion, Alex. This isn't a small amount of revenue. This is a very large amount of revenue. But as I said, by my calculations, they're still losing $60 million on $1 billion of revenue. Now, tell me where you think there's a problem. So their COGS, which you're very proficient and an expert at, cost of goods sales is $478,000. So almost 48% of their revenue is going to cost of goods sales. Now, cost of goods sales would be, at least the way we do it at V-Trips, it'd be everything that drives the incremental vacation rental. So that would be your cleaning cost, because if it's not booked, you don't have to clean it. That would be maintenance cost, because if, again, you would be going directly to cost of goods sales. We put into COGS also any type of OTA. So if we're paying the OTA 15% or 10% or 5% or whatever the variable cost is for that sale, even Google paid click, if we can attribute it to the sale, we attribute it to the sale. Any merchant processing fees are attributed to the sale. So, that's traditional COGS. Am I leaving anything out of COGS, cost of goods sales?
No, I mean, those are the costs. And I mean, to answer your question, what clearly is going wrong is if you have no central economies of scale, and sort of we just talked about another deal that was announced today, which is Sonder Marriot, which is same proof of that. If Sonder can't pull off a brand, and Vacasa clearly didn't pull off a brand, so they needed to back into someone who has a brand, in Sonder's case, then clearly it didn't work for Vacasa. So if you don't have any central economies of scale, because your business is fundamentally a local business, then your gross margin is going to be determined by the gross margin, the cumulative gross margin of all of your markets.
Okay, we're going to go to rapid fire, but I will say, I do think their COGS, and again, I don't know everything that's buried in there. It's too high, right? I run P&Ls. Your COGS, your cost of goods sold, depending on the month, and it's going to vary, should be anywhere from 33 to 40%. So they're at 48% on a T12 basis. That is just too high, but they just are obviously not good at managing operations. But rapid fire, they're spending still $240 million on operations, 24%. Does that sound high to you? 240 million.
That's high, clear.
Okay.
I mean, and the other another thing that we've said for a long time is you can't be a technology company and a subscale property manager at the same time. That's another big issue. There's no point spending on technology when you don't have to scale. You're building your own PMS, you're building your own operation system, you're building everything. Just buy it from others as everybody else is doing, because you don't have to scale to support it.
But wait, Alex, they're spending 63 million a year on technology. Is that too high?
Well, I mean, clearly, but I mean, the worst thing is that it's not that it's too high. It's both too high and not enough.
Okay, here's the other big one: $191 million on sales and marketing. And keep in mind, we just talked about COGS, which would have quite a bit of marketing in it, right? Cost of goods sold. So this is above and beyond cost of goods sold. 190 million on sales and marketing.
Yeah.
Okay, so when you add all of these crazy costs together, you come up with just about $631 million of G&A, which is just incredible. And obviously they're losing, give or take, 60 million a year on a 12 carry basis. But to me, this is just a poorly run business. I mean, I don't think it's a European versus US problem, but you're more familiar with Europe. I think it's just a poorly run business. I mean, these are terrible results. This is a company that could not manage their costs. Tell me where I'm wrong. Do you like to push back? Is it a Europe issue? Is it a US issue, or a bad, poorly run company?
I think, Steve, you're half wrong. I think it's a little bit of wishful thinking on your side, because to say, I don't disagree with you on one of your premises, which is that Vacasa has execution issues. I think the market and everybody else thinks that. I also think there's some bigger issues, which are also more interesting for this conversation because they affect all of us in the industry, that are also affecting Vacasa and that will affect all of us. And one of those questions is, can you build a centralized business in vacation rentals? I think the European comparison comes from the fact that, like, sort of at first look, it might appear that European vacation rental managers have been more successful at having centralized businesses because there are a few that have more scale. And it's an interesting question to dig into. What's different and why is that? And if you look at companies like Aways, there's a collection of brands that has, give or take 90, 100,000 units, much larger than Vacasa. By units under management. If you look at Sykes, there's a few others in Europe that have reached like nothing along the scale of distribution platforms, the Airbnbs and Booking.coms, of course, but certainly a significantly higher scale than what we have in the US. Many of the European companies are actually very old companies. They came out of catalog marketing, they're 50, 60 years old in some cases. So they have their customer bases, they have 80, like they used to have 80% direct distribution. So they had a claim to fame from that. And that's basically what you're buying. And then the actual management of the property, sort of the changing the turnover and sort of the local stuff was done by a local agent. And if you divide those two, you can build a more scalable business. But I think that's something that's unique to the European market. That's we'll see to what extent it's applicable to the US. Now, the second question is it continuing in Europe, or are they retreating too? I'm not seeing a big push towards centralization in Europe either, and consolidation. If I look at Aways, when they got acquired, they had 110,000 units under management. Today, according to their website, they have 90,000 units under management. So I don't see this as a runaway model that's taking the market by storm.
Okay, so Alex said a lot there. what he's basically saying is that the European companies like Aways, like Sykes, and others that have done a really good job and are clearly profitable, because we've seen cases of them getting recapitalized at huge monetization values. Platinum Equity was the more recent one, but Aways almost went to market at trying to raise about 2.1 billion on another recapitalization. So clearly, both of them are making a lot of money. The problem in the U.S. market has been, one, execution, and two, I think what Alex is saying is they went down, they were kind of one-dimensional. He said that the European companies are more multi-dimensional, where you can get unbundled services from them. So you can do full service, they can just do the marketing. I guess some of them will just do operations. And so, it covers their G&A in a better way.
Well, it's more that the centralized services, if you split out centralized services, they obviously scale. I mean, as Airbnb has shown, the thing that doesn't scale, or the thing that hasn't scaled in the traditional model, and I'll get back to that later, is the local services. So if you can unbundle local services and centralized services, then you've got something to walk on. So we talked about Evolve and that model briefly. I think the reason why that's probably not the way things are going is, in Europe, the managers that have been successful with centralized services have one thing in common, is that they have very, very strong direct component. As in, I said before, Graham Donahue from Sykes used to say that he does 84% of his bookings are direct on his platform. I think the sort of Aways overall was sort of in the 70-80% range. I don't know where they are now. I think that's a position to hold on to. That's essentially what Airbnb has been doing. If you own the bookings, you have a value proposition and you can charge for it, and you probably have some scale because you build a brand and it's a recognized brand.
Right. So Evolve, from what we have heard, has also been struggling with attrition. I think there's a number of high-profile companies that attain private equity that have also been struggling in the U.S. market. Now, some of those could be U.S.-centric issues, which I've kind of written about in a couple posts. The U.S. market, I think, has been a market that has not rebounded to post-COVID international travel. So we don't have the international travelers coming inbound. We have a lot of Americans going outbound, which is not great. But inbound, the Canadians, the people from the UK, South America, et cetera, haven't come back. And some of that is currency related. Some of it is economics. Clearly, currency plays a big factor in places like the UK, Canada, Brazil, Argentina, but also I think even Europe, granted, it hasn't been as big of a difference in the dollar to euro, but some of the issues could be that there's safety issues seen by Europeans coming to the US market with mass shootings, et cetera. Either way, we haven't seen the international travel come back. Meanwhile, US travelers in record numbers have been going abroad and the cruise ships, et cetera. So I think that certainly has not helped the US market. We'll see what happens going into 2025. But, you also talked about this today's transaction of Sonder, which I don't really understand it. So I'm going to have you try to parse this. Their stock is up 74%. Granted, they look like they were on death's door at Sonder. They were down to $20 million market cap. They were almost delisted again by NASDAQ. And all of a sudden, they enter the strategic license with Marriott, and they have a 74% increase in their stock. But I don't necessarily understand this unless Marriott is actually taking over Sonder. But try to help me understand this.
So I can't, because there's one line in the press release that's super interesting, but it's just one line and doesn't actually give you any details whatsoever, which I'm assuming there's a filing coming out. But I mean, like, so the big picture is obviously it proves the same point that we just discussed with Vacasa. Sonder tried to build a brand, and clearly they concluded that building a brand subscale isn't going to work. It's certainly not going to work with the capital that Sonder has available. So they're backing into a large established brand, into Marriott. They're looking for their distribution. So, so it confirms the thesis that if you want to build a brand, you better be Airbnb, Marriott, one of the very, very big guys, and you can't build sort of niche brands in this market, certainly not in this market with the funding that's available. And then number two, with Marriott, of course, they now have much, much better distribution, which goes to the point that it's very, very difficult to build a brand and build your own distribution.
Well, why wouldn't Marriott just buy Sonder? Why not just do a stock swap? I mean, they were trading on 20 million, 25 million, which is a drop in the bucket for Marriott. I mean, why would you do this convoluted strategic alliance? And it looks like another entity is backing it up.
I think it's I don't know. I'm obviously not privy to any of the details of the deal, but other than what's been announced. But it sounds sounds like a very small deal to me from a Marriott perspective. As in, they're basically getting royalties. They're getting franchise, like they're essentially franchising the Marriott brand to Sonder, and putting them onto a distribution system, which means they have no cost and all the associated revenue with it. So what's not to like about that?
What's not to like is Marriott's track record dealing in the vacation rental industry. I think it's been a failure, and I'm not sure how this takes them to a position where it's going to be a success. So the one thing I would have thought is if you could control the guest experience from end to end, that's going to be a much more hotel-like experience as opposed to, Marriott having turnkey and Vacasa inventory where obviously they can't control the end-to-end experience. You could take a look at all kinds of reviews and sites, Facebook pages, etc. The complaints about Vacasa are off the chart. I mean, there's just terrible guest owner complaints. So obviously Marriott cannot control the end-to-end experience, and having 150 or whatever their number is now, 150,000 units where they don't control the end-to-end experience is a problem. If the goal is to use this to supplement areas where they have less hotels, and also to allow Bonvoy members the ability to burn off, points. You don't want to put your Bonvoy members, which are your best members, in substandard accommodations. I just don't understand this. I mean, without taking control of Sonder and taking control of the end-to-end experience and putting it under the umbrella, which would be somewhat similar to One Fine Stay, I don't understand how Marriott controls this, but you've been
Steve, I love what you're saying, because you sound like properly sales right now. Because that's a point that I've been making for a very long time, that if you've got a large brand, sort of riding on it, you absolutely have to control the experience. And, sort of to go back to our previous conversation, I think that's been one of the differentiating factors of how the sort of larger European brands have managed the experience. If you look at an Oversoul, which is sort of core to the Oasis portfolio, that's very, very much about, sort of giving the customer a brand that they can look to guarantee their experience, to have a consistent experience, no matter where they go on vacation. If you look at sort of what Interhome and other European managers used to do, and Simon Lehman's talked about that frequently, is to make sure that they guarantee the quality of the accommodations that they sell. And sort of clearly in the US, that's worked very well, I think, or it's worked generally well at the local level, where a local property manager has a large degree of insight and control over the units that they manage. And it's worked much less well with a centralized model. And sort of, you're right, I think of the fact that, for instance, Vacasa, if you look at AirDNA, they used to have a section where they would show reviews, aggregate reviews of the top 5 managers. I believe that section suddenly disappeared, and I wonder whether that has to do with the fact that Vacasa now has a referral agreement with Sonder, with AirDNA, where AirDNA pushes customers to Vacasa. And it's just been a little bit embarrassing given that Vacasa always had the lowest score of the property managers.
All right, so Alex, question on Sonder. I cannot find more recent quarterly filings. I thought they were a publicly traded company, and
Yeah,
yet
I think they had a big. I vaguely remember they had a big accounting issue on. It wasn't a fraud issue, but it was just an issue on how they classified certain leases. And they've been going back again and again, saying that they have to delay their. Yes, but I agree with you.
But Alex, why would Marriott get into bed? I mean, this just sounds like a mess, like just a mess. Now, I did find from our friends at FocusWire a little bit more detail of the funds. It looks like 43 million from an investors consortium, whatever that means, and another 83 million from existing Sonder note holders, whatever that means. It looks like some of the people that had money are still believe there's value in Sonder. I don't know how you can even figure out if there's value in Sonder when they haven't released earnings. It looks like at least 6 months, and they have all kinds of accounting issues. I mean, again, why would a public company like Marriott get messed up with a company like this that is this messed up? I mean, this company, I'm surprised they're still even public, given that they can't even put out quarterly results.
Yeah, and I think the being public is probably going to be a question of time because I think they're triggering a whole number of listing issues, both with their stock price and of course with the accounting issue. But clearly, when you have accounting issues like you discussed and the insiders are putting up money, it says something because the insiders probably know what's going on better than we would know from the outside.
All right. Well, as much fun as it is to talk about Sonder, we must move on to one more company who I know Alex loves, although maybe not as much love today, and that's Airbnb. So Airbnb,
and it's by the way, I tend to not love nor hate companies. What I want to keep reminding ourselves on is, Airbnb has been, whether you like them or not, and I wouldn't say that I necessarily like them. I see them as a necessary evil that's done sort of a lot for the industry. But Airbnb has been the big success story in our industry, and we tend to forget that when we engage in Airbnb bashing. That doesn't mean that what they do is right. Doesn't mean that they're not in it for themselves. Absolutely true on both of those. I mean, it doesn't mean that they don't screw up. I mean, we talked about the flywheel last time, I think. And if you've got a flywheel like Airbnb's, you can screw up a lot and still do quite well. But sort of they've transformed the industry for sure.
Okay. Well, we're not here to bash Airbnb. I'm fascinated by this company, but we're also not here to call them a cash volcano or some of the other things I've heard by some people who are pushing their story. So let me just kind of sum up what's going on at Airbnb. So today, Airbnb is trading at $116 a share with a $73 billion market cap. That's pretty far off its high of $170 a share and fairly close to its 52-week low of $110 a share. Now, Airbnb's enterprise value to revenue range, and there's a bunch of different multiples you can look at. I went to Yahoo Finance. They're trading, their PE is at 27x forward multiple versus on March 31st, it was at 36x. So they've come back down to earth as they've revised their profitability. And I think the thing that stood out, maybe they want to talk to their comm director, was they said on the earnings call that it expects a sequential moderation in year-over-year nights and experiences booked compared with the second quarter. So they certainly didn't sprinkle a whole lot of hope. And then they claim that Latin America and Asia were their fastest growing markets. Well, those are also the lower ADR markets, and that their length of stay was dropping, and that the US market was slowing down. And anyhow, it certainly wasn't a happy earnings report, not because the earnings were off, or at least the guidance was off, but just because it didn't seem like they were painting a story that they would correct this. Now, am I being too pessimistic? Because you've always been more optimistic about this company.
No, look, a couple of things. Like, I have been optimistic. I think we had two calls or two podcasts. And the first one, I said I'm very bullish on Airbnb, and I ended up being right. The second one, I said I'm bearish on Airbnb, and I was right again, since I've been going both directions. I think Airbnb stories, they clearly are the industry leader in distribution. Yeah, sort of they've built an amazing business that is very, very, can generate a lot of cash. What you're seeing right now is also that Airbnb has traded on growth for a long time, and they've delivered that growth, and that growth is moderating. I mean, as they said, very, very much so. If I look at first quarter 22, they were still growing at 59%. That was sort of the post-pandemic revenge travel and all of that. And then if I look further out, with sort of next quarter was 25%, 25%, 20%. Now we're down to 10%, and it's a very, very clear line. You know, sort of this is a company that right now is growing nowhere close to at the rate that it's been growing.
Oh, okay. So we have I listened to this podcast by Scott Galloway. They call him Professor G. He calls Airbnb the best travel brand in the last 20 years. I would contend the professor is wrong, that it's Booking.com. So let me go over Booking.com's latest data. So Booking.com is at about 3,600 a share. It's off its 52-week high of 4,100, but certainly far from its low of 2,700. It has a market cap of $121 billion, and their forward PE is now up to 21x. It is getting very close to where Airbnb. So Alex, who would you rather be holding shares in right now, Booking.com or Airbnb?
That's a tough one. By the way, I like Booking.com a lot too. You know, so I think to answer your questions, let me do it in a roundabout way. If you you should want to hold shares in Airbnb because they're both bets on the sector. Airbnb is a bet that vacation rentals is going to outperform hotels, and that vacation rentals is a standalone category that has its own dynamics, right? So if people continue to say, if I want to book a vacation rental, I go to Airbnb, then Airbnb has, you know, a number of very good years ahead still. Booking.com is an integrated play that came from hotels, built a very interesting vacation rental business, but the bulk of their business is still hotels. So Booking.com is a story that says the two are substitutes for each other. And, you know, sometimes I book a hotel and sometimes I book a vacation rental. And since I'm too lazy to jump around between different sites, I may as well go to the site that has them both in spades, and that's Booking.com. So depending on which of those two stories you believe, if you'll go with Booking.com or Airbnb or the other way around. For us as an industry, we probably want to believe vacation rentals is its own category that's not substituted by hotels. In terms of company value, I absolutely agree that Booking.com should be the more valuable company. And let's go back a little bit, where there was actually a while where Airbnb was more valuable than Booking.com, which was kind of crazy, given that Booking.com had this huge hotel business plus vacation rentals, and Airbnb just had the short-term rental part.
Yeah, it was 6 months ago that Airbnb was more valuable than Booking.com, and it had been more or less that way since Airbnb went public. But Booking.com has steadily grown their market cap. They've been consistent. And you brought up the one point. You keep saying, well, Airbnb is vacation rental. Booking.com is travel. And I submit that, you know, the line is blurring between what is a vacation rental and what is not. And if you use Booking.com in Europe, it is almost impossible to tell on a default what is actually a hotel, what's a bed and breakfast, what's a pension, what's a vacation rental. You're just given a lot of different options, and then you filter it. So it just has a bigger universe of options. And then they also allow car rentals and cruises and air as well. which makes it a lot easier for a traveler to have everything stored on one app versus just going to Airbnb. Now, I know there's people that still support Airbnb. They still have some unique supply, but the bigger issue is as they're slowing down, one of the few bullets they have left is to start to spend money on different channels like Google, like TikTok, et cetera, to drive more travelers back to their site. The problem is they can't monetize that traffic as much as Booking.com because they don't have as many different options. So where am I wrong on that? I mean, it just seems like Booking has a superior business model.
I mean, I think so. Let's take a step back. When we talk about Airbnb, let's remember for a second, Brian Chesky was an absolute hero coming out of and I'm saying not what I think, but what the market thought, was a hero coming out of the pandemic because he'd been doing very much what Booking.com is doing today. He'd started to spread Airbnb into everything from flights to experiences and so on and so forth. And then when the pandemic hit, he did, I think, by most accounts, an amazing job at focusing on just one thing, which is the thing that Airbnb does best, which is short-term rentals. Now I think we're sort of seeing the end of that period. And now you're right. I mean, Booking.com has always had a much larger platform. I mean, they had a huge hotel business for a long time. This is not a new company. And they've very diligently built up a vacation rental business on the back of their hotel business. I mean, Booking.com's claim to fame in vacation rentals, because they can't compete with Airbnb's brand, or they couldn't. What they do is they cross merchandise, right? So you're looking for a hotel and they say, hey, by the way, have you considered a vacation rental instead? Which again is great for us as an industry because they can funnel some of their traffic over. I think Booking.com's had this idea of, I think they call it the connected trip for a while, that integrates all of the different pieces. So go book your flights from us and your airport transfer and your experiences and of course your accommodation. And I think, sort of what Airbnb started to say is they're going to start heading into that direction again, where when their sort of core segment is starting to slow down, they also need to think about what's next on the horizon for growing again.
All right. So you've said a lot. Obviously, I was not smart enough to buy Priceline in 2006 or 2007 when they acquired Booking.com. But if you look at the history of what happened.
By the way, the guy who did that got the ultimate reward, is now running the company. That probably was the best acquisition in the history of acquisitions.
So if you look at the history of Booking.com, it was a really, really smartly done hotel platform that made it easy for suppliers to put on their inventory. The commission was a little bit more reasonable than Expedia and some others. And they started to really have a lot of traction in Europe. And then somewhere around 2014, they started to bring in more than hotel inventory, as you stated. It started with boutique hotels, but then it went to bed and breakfast, and then to pensions, which in Europe are kind of family-run inns or whatever you want to call them. And then around 2016, they started to reach out to vacation rentals, and they started to make it easier for companies to load vacation rental inventory. And then probably in the last couple of years, they've added car rentals, air, and cruises. So, they didn't get there out of the gate. They've got there slowly. But the one thing about Booking.com has been the management team. They have an extremely strong leadership team. They're numbers oriented. And to do this, as you said, didn't happen overnight, and it required great leadership. Why do you think, what has Airbnb shown you with their leadership team that allows you to believe that they can do what Booking.com has done, become a multi-distribution channel for travel, not just vacation rentals?
Overall, I think Airbnb's done very well. They built close to $100 billion company in a 10-year time.
71 billion now, Alex. It's going
71
down.
billion. Yeah, okay. No, but it's bigger than anybody has ever built, certainly in our category, in vacation rentals. If I look at our success stories, as in biggest public quoted companies or Vacasa and Sonder, I don't disagree with you for a second that Booking.com is an execution machine. Like they've done really, really, really well on like they go after the segment and they're methodical, they're diligent, they're thoughtful. They're not visionary, but they really, really execute, and they're known for that. I think they also have one thing going for them in that where they come from is the long tail of hotels, which is a much, much bigger deal in the US, sorry, in Europe than it is in the US. The US hotels are fundamentally branded. It's, people, you have your favorite brand, whether that's Marriott or Hilton or whatever it is, or sub-brand. In Europe, the long tail is really, really powerful and is the majority of the market. It's all those little family-owned boutique pensiones and whatever you call them in the different countries, small hotels. And for them, Booking.com is the bread and butter. They have to get distribution through Booking.com. They've got their, sort of guests that return every year, and then they get guests from Booking.com. Because our industry looks quite similar. We also a massively fragmented industry. I think generally that bodes quite well for Booking.com to do well in that segment. Now, as to Airbnb's execution, we can discuss about mistakes that they've made, and they've made a few. But on average, like if I think on how they've done over the last 10 years, and particularly how they've done coming out of the pandemic, it's been actually a remarkably smooth ride, which for something that could have been an extremely bumpy ride.
All right, Alex, we're at almost the end of time, so it's going to be lightning round. You have to answer one or two sentences. Airbnb icons, good idea or bad idea?
Bad idea.
Okay. Airbnb losing market share in Europe. So in 2022, according to key data, Airbnb was 41% of property managers. In 2024, 38%. Meanwhile, Booking.com in 2022 was 29%. And in 2024, it's 40%. So now Booking.com among professional managers is now beating Airbnb. Who are you more optimistic in the future in Europe, Booking.com or Airbnb?
I think the jury's out, but it's definitely what Airbnb is watching very closely, and I think they're super worried.
Dropping ADR in the U.S. market. Airbnb was telling suppliers to drop ADR. Good idea or bad idea?
Good idea.
Keeping the founder Brian Chesky as the CEO of Airbnb. Good idea or bad idea?
Good idea.
Airbnb thinking that China is a market for additional penetration. Good idea or bad idea?
Very difficult to do.
All right. Anything else you want to say about Airbnb? Because
on China, I think that requires a little bit more than 2 words. I think sort of outbound China was a big force, and I think will be a big force. So if you don't do it, you'd be crazy. But that doesn't mean doing it is easy. It's incredibly, incredibly difficult.
So you're optimistic the China market recovers because, Alex, we haven't even talked about this. But we could be on the verge of a global recession, starting with our friends in China. China's already in a recession, right? You're aware of that, and it's pulling down Japan and Korea. And China hasn't recovered, and the Chinese travelers haven't returned to Europe or America. So you're optimistic China's coming back because there's a lot of inherent problems, not the least of which is the population is worse than in Italy right now in terms of the number of people being born per couple. It's like 0.7 or less.
So, sort of 2 things. I'm never going to be the one saying China is easy. It's incredibly, incredibly, incredibly difficult. I'm not going to say that they don't have big problems ahead. Absolutely. But I also think anybody who builds a global strategy without taking account of China would be crazy.
Okay. So we're going to leave it there. Alex is still optimistic at Airbnb. Is it a buy at 114 a share? Are you buying?
No. I said last time. I already said in your last podcast, like I think there's more downside to Airbnb than there's upside in the short to medium term.
What about long term? Is it going to go above that 70 billion market cap that they're down to?
Look, I'll remember when I was wrong much more than when I was right, and I remember that I was absolutely convinced that Amazon was the most overvalued company ever, and that was, that was in 2000 or so. And yeah, sort of, I was saying exactly what you're saying about Airbnb right then. Like, sort of, how could anybody ever think that something like this is going to be worth anywhere close to what it's trading at? And I was right for about 7 years, and then I was absolutely terribly wrong. So, yeah, so we'll see.
All right. So Alex is a bear, short to medium term, but maybe a bull long term on Airbnb.
I fundamentally, I think marketplace models are incredibly powerful. Once you cracked it, you can make a few mistakes and still come out really, really doing well.
All right. We'll leave it there. Thank you, everyone, for another episode of Straight Fire VR. Thank you, Heather. Thank you, Alex.